Hello and welcome to TradeFlow Television,
bringing you valuable analysis and actionable intelligence
through the global commodity markets.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Copper trading on the CME and London Metal Exchange tumbled last month as funds and speculators fled from high volatility during the coronavirus pandemic, but volumes shot up in top metals consumer China as lockdowns were lifted. Dealing activity in copper, the metal widely regarded as an economic barometer of the global economy due to its industrial uses, has withered in the West and analysts expect it to remain weak after sharp swings on the market.
Moving on to the top energy news for this week.
Poland will close 2 coal mines owned by state-run JSW and 10 mines of PGG Group on Tuesday for 3 weeks to stop the spread of the new coronavirus among miners, Deputy Prime Minister Jacek Sasin said. Miners account for almost 20% of recorded coronavirus cases in the country, which generates most of its electricity from coal.
Northwest European gasoline refining margins rose to their highest since mid-May at just over $2 a barrel on Monday, supported by growing demand on both sides of the Atlantic. Arbitrage opportunities to North America have been pressured as European prices gain on the back of easing lockdown restrictions, but remain workable with freight rates continuing to soften, according to Refinitiv analysts. Export volumes are fractional compared with previous years, but we expect higher volumes going forward as spot buying picks up, while U.S. refinery hubs face more challenges as hurricane season looms, Refinitiv analysts said.
The value of Angola's oil exports fell by just under 48% in May from April, figures released by the Finance Ministry showed. The resource-dependent country's much-needed cash from crude fell to 225.3 billion kwanza $381.4 million in May, down from 432.5 billion kwanza in April. Both output and prices slid, with total exports falling to 40.96 million barrels in May, down from 44.59 million barrels in April, while average prices dropped to $18.24 per barrel, from $29.60 per barrel.
Up next we have the top agricultural news of the week.
The U.S. government boosted its already robust outlook for domestic corn supplies on Thursday, with a reduction in ethanol production outweighing a cut in the estimate of last fall's harvest. Wheat supplies also were seen rising due to surprise increases in the forecasts for the ongoing U.S. winter wheat harvest and global stocks, which sent futures prices tumbling. In its monthly supply and demand estimate report, the U.S. Agriculture Department pegged corn ending stocks for the current 2019-20 marketing year at 2.103 billion bushels, 5 million higher than its May projection. It lowered its estimate of the amount of corn used by ethanol producers by 50 million bushels and cut its harvest estimate by 46 million bushels.
U.S. exporters reported sales of 720,000 tons of soybeans to China, the U.S. Department of Agriculture, USDA, said on Thursday, as active purchases by the world's top soy importer continued for a second straight week. The USDA confirmed the sales, after reporting that weekly U.S. soybean export sales last week were the largest in at least 16 months, with the majority slated for shipment to China, or undisclosed destinations widely believed to be China.
We will now take a look at the energy price move.
Oil prices slid early on Friday, extending heavy overnight losses on a surge in U.S. coronavirus cases this week that has raised the prospect of a second wave of the outbreak slamming demand in the world's biggest consumer of crude and fuel. West Texas Intermediate CLC1 was down $1.32, or nearly 4%, at $35.02 a barrel by 0011 GMT, after slumping more than 8% on Thursday. Brent crude LCOC1 was down $1.15, or 3%, at $37.40 a barrel, having dropped nearly 8% the previous session. Brent is heading for its first weekly decline in 7, dropping about 12%, while U.S. crude is heading for a loss of around 4% in its second consecutive weekly drop.
Asian spot liquefied natural gas (LNG) prices remained steady this week, but were still hovering near record lows in response to oversupply and high inventories in the region, several trade sources said. The average LNG price for July delivery into Northeast Asia LNGers was estimated to be about $2.10 per million British thermal units (MMBTU), similar to the previous week, they said. Prices for cargoes to be delivered in August were slightly higher at about $2.20 to $2.30 per MMBTU, they added.
Oil prices rose more than 2% early on Monday to their highest in 3 months after OPEC and its allies including Russia agreed to extend record oil production cuts until the end of July. Brent crude LCOC-1 climbed to as high as $43.41 a barrel and was trading at $43.32 by 0000 GMT, up $1.02, or 2.4%. U.S. West Texas Intermediate WTI crude CLC1 gained 83 cents, or 2.1%, to $40.38 a barrel. Both hit their highest since March 6. Brent has nearly doubled since the start of April, propped up by an unprecedented production cut of 9.7 million barrels per day by the Organization of the Petroleum Exporting Countries (OPEC), Russia and allies.
Next is price moves in the agricultural sector.
Speculators built a net long position in raw sugar on ICE futures US in the week to June 9, adding 10,280 contracts after having erased a previous short position last week, data from the U.S. Commodity Futures Trading Commission showed on Friday. They now hold a net long position of 9,547 contracts in raw sugar futures. Sugar prices on ICE SBC1 hit a 3-month high this week as the market remained supported by a relatively tight outright supply in the physical market. A different outlook seems to be forming on coffee, however. Speculators have increased their net short position in Arabica futures on ICE by 6,326 contracts for a total short of 17,489 contracts by June 9, CFTC data showed. The near-normal pace of harvesting in Brazil and Colombia, the two largest producers of Arabica, despite measures to avoid contagion of workers by the coronavirus, points to a well-supplied market in the months ahead.
Soybean futures were near unchanged as the USDA lowered export expectations, even after recent purchases from China supported prices. Corn advanced as the USDA reported better than expected demand for corn-based ethanol. CBOT soybeans SV1 were up 1 cent at $8.66 and a half a bushel, and corn CV1 was up 2 cents at $3.28 and 1/4 a bushel.
Moving on to metal price moves.
Copper prices climbed to 3-month highs on Monday as economic stimulus from central banks, expected stronger demand in top consumer China and falling inventories in Shanghai triggered fresh buying. Benchmark copper CMCU3 on the London Metal Exchange, LME, was up 0.2% at $5,700 a ton at 1549 GMT. The metal used widely in the power and construction industries earlier touched $5,708.50, its highest since March 5.
Now we will be updating on the global market.
The US dollar rose against the safe haven Japanese yen and Swiss franc on Friday as stocks on Wall Street rallied from their worst one-day performance in 3 months, while the euro dropped against the greenback, erasing early gains. The yen fell against the dollar for the first time in 5 sessions, while the Swiss franc declined, as Wall Street rallied to claw back some of the sharp losses suffered in the prior session.
Global equity markets rose in choppy trading on Friday as concerns triggered by the U.S. Federal Reserve's less-than-optimistic outlook for an economic recovery and a jump in U.S. coronavirus cases gave investors pause. The 3 major U.S. stock indexes rose by at least 1%, a day after the market's worst single-day drop in 3 months. MSCI's gauge of stocks across the globe gained 0.34%.
Finally, we will look into some of the significant economic news from this week.
U.S. stock futures and Asian shares advanced on Monday after a surprise recovery in U.S. employment gave further confidence of a quick economic recovery after many weeks of lockdowns aimed at controlling the coronavirus pandemic. The Labor Department's closely watched employment report also showed the jobless rate falling to 13.3% last month from 14.7% in April, a post-World War II high. Economists had forecast the rate jumping to 19.8%.
Offshore crude oil production in the U.S.-regulated northern Gulf of Mexico was down 13%, or 242,681 barrels per day, BPD, on Thursday, 4 days after Tropical Storm Cristobal came ashore, the U.S. Bureau of Safety and Environmental Enforcement, BSEE, said. Natural gas output from the offshore Gulf of Mexico remained cut back by 9%, or 241 million cubic feet a day, after the storm, the BSEE said. U.S. Gulf of Mexico waters account for about 15% of total U.S. crude production and 5% of U.S. natural gas output, according to the U.S. Energy Information Administration.
That is all for this week's news. Stay tuned to TradeFlow TV as we continue to provide daily updates on the commodity market.